Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at therogueagent.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. I have some money sitting in a savings account. Not sure if I should move this into my whole life policy via the PUA rider. How does the guaranteed interest rate on my whole life policy's cash value compared to what I'd earn in a regular savings account over 20 years? Okay, so, it depends on the period of time when you invested, and whether you invested in a regular savings account or a high yield account. So over time, interest rates on a savings account have changed. So, there's going to be times when those look better than whole life insurance, and also definitely times when they'll look worse. Let's see, I've got a breakdown of over the last 20 years of various interest rates. So if you had, let's say you had put money in a savings account in between 2005 and 2008, you would have earned an average of 4.5%. Like, so some banks would have paid you more and some less. I mean, you not everybody was had the same headline rate. From 2009 to, let's say, through 2015, the interest rates on those accounts dropped to between 0.5% and 1%. So maybe you get an average of 0.75% interest on your money. So that's if you keep your money in the account, of course, they just readjust the rate. So it's not like a bond where you buy it and then you get it for 5 years or 10 years or however long you hold the bond. It's those rates roll over to whatever the new money rates are. So from 2016 to 2019, the average was somewhere between 1.5% and 2.5%. So you might have gotten, let's say, on an average 2% or whatever. From 2020 to 2021, it dropped back down again from 0.5% or to 0.5% to 1%. Again, like 75 basis points. And then from 2022 to last year would be 2025 as of this recording, rates average somewhere between 4 and 5.5%. So let's say you could get, 4.5, 4.75, let's say. So, it just really depends, if you add all those up, the weighted average return on a savings account across the U.S. is about 2.3% APY. So for regular savings accounts, like maybe 0.5%, and this is before taxes, so the net figure is going to be a little bit less than that, depending on your personal tax rate. So whole life policies, in the first, let's say I'm going to just say like between the first 7 to 10 years, you're not earning a lot. right? So let's say in the first 10 years, you are probably, well, it depends on what savings account period and what yields you're getting. But on a lot of these, you would have been better off in a savings account for the first 10 years. Because why? Well, because if you're earning 4 or 5% or whatnot from day one, it's going to be, it's going to be a lot more than the, maybe 1 to 3% that you're getting out of your whole life policy. And in the first, let's say 3 years, 4 years, maybe, or definitely the first 2 years, your whole life policy has a negative return. So the compound annual growth rate, the net compound annual growth rate on whole life cash values turned out to be somewhere between 4 and 6% over the last 20 years. So even though it started lower than the savings account, it actually pushed it up higher. So even if you started out better in the savings account, after maybe, I said 7 to 10 years, somewhere in that range, you started to do better in the whole life policy. And by year 20, the whole life policy did better. So let's say if you're 20 and you're buying whole life, you're 30 or 40 years old, even if you're 40 years old, let's say, and you buy a whole life, by the time you're 60, you beat out a savings account and probably some other things too in the fixed interest world. So I think for most people, this was like a no-brainer. Yes, there were definitely times where you earned more somewhere else in the short term. And this is kind of, I relentlessly mock the short-term thinkers. 10 years for a lot of people is not short-term, but in the grand scheme of things, if you're in your 30s or you're in your 40s, figure you're going to live another 40 years, at least. Depends on, future medical technologies, but give yourself another 40 years, right? If you're 40 years old, if you're 30, even more, right? So 10 years in that context is not that long. It's like 1/4 of the time period that you're looking at. So you got to hold it for decades, right? But that's the whole point. The whole point is that you hold on to it for decades. Like you buy it, you look, they say, like, there was that old saying, you skate to where the puck is going. So you look out in advance. You don't look at like the 5 years, 6 years, what is your 1 year return or what, like, that's stupid. So buy the policy and say, okay, when I'm 80 years old, this is kind of the target that I'm trying to hit by age 70 or 80. And the time between now and then, just discount. It doesn't really matter. It matters, but it doesn't really matter that much. What matters is that you get to where you're going. All right, so let's see. Next question. Can I use the cash value from my whole life policy to pay for a living benefit rider after my policy is issued if I get sick, or do I need extra funds for that? Can I pay for the cash? Can I use the cash? Oh, so wait a second. Can I use the cash value from my policy to pay for a living benefit rider? I'm not sure exactly what this is asking. Are you asking use cash value from the rider? Oh, can you pay for? Oh, like, can you? Maybe they're trying to ask if can you put a living benefit rider on after your policy, or use cash value to pay for a rider later. So no, every living benefit rider that I've ever seen over the past 20 years, you have to have the rider on your policy at issue. You cannot add it later. So meaning, if you don't elect it when you fill out your application and it's not on the policy when you make your first premium payment, you don't get it. I've never run into an exception to that rule, but that doesn't mean that there's never been an exception. It's just I've never seen it. So next question. With an IUL, what happens to my cash value if the stock index it's tied to crashes for a couple of years? Am I protected? Yes. More or less, yes. Your cash value is not going to crash because of a stock market crash. However, the policy charges in the policy don't stop. So those charges might exceed any interest credits that you get. So it is possible. If the stock market is, let's say, flat, it crashes and you're not getting any interest credits from the indexing credits, it's possible, and in fact, it's probable that your cash values are going to go down. If there's a zero interest credit for multiple years in a row, you're absolutely going to see your cash value go backwards. So on its own, it's not the end of the world, but it becomes a much bigger deal once you start taking policy loans. It also starts to becoming a bigger deal as you get older. And the reason it becomes a bigger deal as you get older is because the cost of insurance is rising. And so when you first take out your policy, if you're in your 30s or 40s or whatever, it doesn't matter quite as much because the cost of insurance is going to be relatively low when the policy first starts at a younger age. But by the time you're, 60s, over 65 definitely, but, 65, say 60s and 70s, and you're like, oh, this is where you want to have a whole bunch of cash value build up. If you start getting zeros in those years, the cost of insurance at those older ages is going to be really high. So the zero crediting hurts more in those older ages. Now, hopefully you have enough cash value there that it's a pretty big buffer. But I have seen, I can't believe it, still can't believe it. Some part of me still can't believe it, but I have seen IUL policies that have been enforced for 20 years and have, maybe a few $1,000s in them. And the premium amounts are, 5-figure premiums, so it's, and in order to keep some of these policies enforced, you have to kind of go to a 6-figure premium. 100,000 plus in premium, you still only have maybe a few $1,000s left in cash surrender value. That's not a really good feeling to have, especially when you get to your older ages. So if you start hitting a bunch of zeros or something happens and your interest credits are not enough to cover the expenses in the policy, could be trouble. So you don't want to do that. And if you start taking loans, like a lot of agents will say, yeah, once you get to your old age, yeah, you can start taking loans, and they show cool loan features and arbitrage on the loans. You can borrow money from the insurance company at whatever they're saying now, 5%, and the index crediting is going to give you 7%, and you're going to make money on all these loans. Well, if if that doesn't work out, and there's hint, there's a really good chance that's not going to work out. Now you're in trouble, right? So indexing always looks good on paper because the illustration never shows you the variable costs of the embedded options in the contracts. The options prices are always changing. They never show you that. The illustrations never bake that into the assumptions. So they never show you the effect of, a change in options pricing or how policy charges are going to change over time. They do show you, let's say, like guaranteed maximums and stuff, guaranteed maximum charges, policy charges and stuff like that. But they don't show you how, changes in options pricing will change crediting. And that's what you want to know. You also want to know, like, what's the effect if the cap rates decrease. Now, some carriers probably, there's a way to show like a decrease in cap rates, but the default is always just, if they sold it to you at a 10% cap rate, they just assume 10% cap rate is just going to stick it out and stay the whole time. If cap rates go up, of course, that looks better, right? So nobody cares about if the cap rates go up. If they go from 10 to 15, like, nobody cares, right? That's good. But if cap rates go from, let's say, 10 to 8 to 7 to 6, all of a sudden now your policy is going to perform much, much worse than what was illustrated. Much worse. So, it's just something to consider. It's a risk. Let's just put it that way.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to therogueagent.com and sign up for my daily email list.